Welcome to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Summit Puri, and thank you for tuning in. This week, as usual, we'll discuss 4 key focus points highlighting the key learnings from the market activities in the past week. In point number 1, we'll do a market recap with our key market indicators. In point number 2, we'll take a look at consumer confidence data. In point number 3, we'll talk about the impact of slowing population growth. And in point number 4, we'll take a look at the PCE, which is the preferred inflation metric by the Feds, or also referred to as the personal consumption expenditures. Now, on to point number 1, the market recap. First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta GDP Now report shows a negative 1.5% growth as of February 28th. Which is a sharp decline from the 2.3% reported last week. This is the first time since I've started reporting this metric to you all that we're seeing a negative number. The drastic change in this data is due to the impact of net exports on our GDP. Net exports for first quarter real GDP growth fell from 0.41% negative to negative 3.7%. Also during this period, personal consumption expenditures growth fell from 2.3% to 1.3%, also contributing to the negative GDP projection. Another key point to note here is that the definition of recession is when we have 2 consecutive quarters of negative GDP. Now, I'm not saying that we're heading in that direction, but I think it's only important that we're highlighting that definition, and this is something that we will certainly watch as we are moving forward. We'll see the real impact of this information over the next couple months when actual data is released. However, historically, the Atlanta GDP Now data has been quite accurate. Next, each week we look at the initial claims for unemployment insurance for a gauge into the front end of our labor market. This week, initial claims data rose pretty dramatically with 23,000 additional claims, or a 10.5% growth, ending at 242,000, while continuing claims fell to 1.862 million. As mentioned previously, we'll continue to watch this metric closely while the new administration continues to make waves and more federal employees are looking for new jobs in the public sector. The good news is that there are still a wide number of jobs available in the public sector. The difficulty, however, is that matching skill sets for those that are newly on the hunt. To all those looking for new roles, I wholeheartedly wish you the best of luck and hope that you're not on the bench for too long. Next, we are watching mortgage rates closely to see how home affordability is trending. This week, we saw minimal movement again in the 30-year and 15-year mortgage rates, ending at 6.76% and 5.94% respectively. Next, we'll look at investor sentiment. One component of investor sentiment is the measurement of the bull-to-bear spread. The latest update showed the bull-to-bear spread fell once again quite dramatically from a negative 11.27% last week to a negative 41.23% this week. Investors are feeling very bearish in this current market, and we'll talk a lot more about sentiment later on in our discussion. Next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating a 7% probability of a 0.25% decrease and a 93% probability of no decrease in March. However, when we look at the May data, we can see that on the next slide that there are multiple rate targets that the market is expecting. As you can imagine, expanding the time range further increases the probability of more volatility, thus more risk and uncertainty. Here we're seeing nearly a 32% probability of a rate cut of either a 0.25% or a 0.5%, and a 68% probability of no cut in May. A combination of time, policy changes, and the aggregate data that we'll get from now until then will truly give us the insight that we need to know what the direction may be that the Feds will go in the future. But until then, it's still hard to say what direction they'll go. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended negative 0.46%. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, was negative 0.68%. And the MSCI EFA, which tracks international stocks of developed countries across the globe, excluding the US, was negative 0.9%. Growth in income stocks took the win this week. I've highlighted key moments from the past week on your screen. Tuesday, the market reacted to the Consumer Confidence Index data. Thursday, to the confirmation of the 25% tariffs on Canada and Mexico, which are expected to start on March 4th. And Friday, the release of the PCE, or Personal Consumption Expenditures data, specifically inflation data there, was also released. Now remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. If you'd like an unbiased review of your portfolio, don't hesitate to connect with one of our advisors today. On to point number 2, the consumer confidence data. In February 2025, consumer confidence experienced a significant decline, with the consumer confidence index dropping by 7 points to 98.3. This decrease, the largest monthly drop since August of 2021, reflects growing pessimism about the economic outlook. The expectations index, which assesses consumers' short-term outlook for income, business, and labor market conditions, fell to 72.9, signaling potential recessionary concerns for the first time since June of 2024. The Present Situations Index, however, which is based on consumers' assessment of current business and labor market conditions, decreased by 3.4 points to 136.5. Several factors contributed to the decline in consumer confidence. Consumers expressed concerns about future business conditions and income prospects, with pessimism about future employment prospects reaching a 10-month high. Average 12-month inflation expectations also surged from 5.2% to 6% in February, influenced by sticky inflation, rising prices of household staples, and the expected impact of tariffs. Mentions of trade and tariffs increased sharply, reaching levels not seen since 2019, with comments on the current administration and its policies dominating responses. The decline in confidence was widespread across age and income groups, with the exception of households earning less than $15,000 a year and those earning between $100,000 and $125,000 a year. Consumers' views of their families' current and future financial situations became less positive, and the proportion anticipating a recession over the next 12 months increased to a 9-month high. Consumers' bullishness about the stock market also decreased, as we discussed in point number 1, with fewer expecting stock prices to increase and anticipating a decline. Additionally, over half of consumers expected higher interest rates over the next 12 months. In terms of consumer behavior, purchasing for homes continued to recover, potentially due to recent declines in mortgage rates, and as we mentioned earlier, very minimal declines. However, buying plans for cars and big ticket items decreased, particularly for TVs and electronics. Consumers' intentions to purchase additional services remained relatively stable, but their priorities shifted towards personal and healthcare, as well as movies and live entertainment, at the expense of streaming and travel. Overall, the decline in consumer confidence suggests growing concerns about the economy's future, influenced by factors such as inflation, trade policies, and governmental spending. On to point number 3, population growth. In the United States, population growth has historically been strong due to a surplus of births over deaths, supplemented by immigration. However, this trend is shifting. The U.S. population grew nearly 1% in the year ending in July 1st, 2024, marking the strongest annual gain since 2001. But this growth is primarily due to immigration. Natural population growth, which is the difference between births and deaths, is shrinking significantly, especially when measured as a total of births against the total population. This measure is called the birth rate of the American population. Birth rates have fallen due to social factors like increased female participation in education and workforce, as well as economic factors such as rising housing and daycare costs. Meanwhile, mortality has risen with the aging population, offsetting advancements in medical care. Immigration has been a significant contributor to the U.S. population growth. Of the 3.3 million increase in the U.S. population over the year that ended in July 1st, 2024, 2.8 million came from net immigration. However, the pace of immigration has fallen sharply. Increased border security and heightened vetting processes could further diminish immigration flows. If net immigration approaches zero, population growth would slow, impacting the demand for housing and basic consumer goods and services. Slower population growth and the potential decline in working age population could have significant economic consequences. A decline in the working age population could lead to supply being hit more than demand, potentially boosting wages, inflation, and interest rates. This could also motivate stronger investments in productivity enhancing AI and robotic technologies. Investors will need to monitor government policies and immigration to adjust their strategies in response to these demographic shifts. Now on to point number 4, the personal consumption expenditures data. In January 2025, personal income in the United States saw an increase of $221.9 billion, which is a 0.9% increase month over month. Disposable personal income, or DPI, which is a personal income minus personal current taxes, also increased to $194.3 billion, or once again 0.9%. However, personal consumption expenditures, or PCE, decreased by $30.7 billion, or 0.2% drop. This mixed financial landscape includes a decrease in personal outlays of $52.7 billion and a personal savings rate of 4.6%, with personal savings ending at $1.01 trillion. Plainly, Americans brought in more money in January, however, they saved more of it and spent less. The Federal Reserve's preferred inflation measure, the PCE price index, increased 2.5% from the same month a year ago. Excluding food and energy, the PCE price index, or core PCE, increased by 2.6% from a year ago. Now, the good news is that the data matched what most economists were predicting. While inflation has decreased from its peak of about 9% in June of 2022, it remains higher than the Fed's target of 2%. Consumer sentiment is soaring amid stubborn inflation. PCE data indicates that inflation rose at a mild pace in January, offering some relief after the previous report suggested inflation was heating up again. The recent CPI report had reinforced the Fed's decision in January to pause any additional rate cuts, but the PCE data suggests that the central bank could still introduce more reductions this year. However, I still believe that multiple rate cuts for 2025 may be overly optimistic based on the current data. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest videos on your feed, including new content released by our team, please make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. Once again, thank you for joining, and we look forward to seeing you next week.